Hey everybody, Boris. Welcome to the Commodity Dollar Technical Update for December 12th to December 16, 2016 for Aussie dollar, dollar CAD, and Kiwi dollar. And I think the central theme of the commodity trade for the last couple of weeks has been the very low compressed volatility relative to the European currencies and all the other majors. Certainly, the Aussie and the Kiwi have been just completely in a shutdown mode, trading maybe 50-point ranges while everybody else is trading 100, 150-point ranges around them. Dollar CAD has been a story of its own, of course, because of oil, and continues to be very much a story of its own because of oil. This week, a lot of things can change really based upon two things. We have, of course, Chinese data, industrial production, coming out of China that could be, if it continues to be positive, could be a nice boost to the Aussie. We have Australian employment, which comes out actually right after the FOMC meeting, which could also be a nice boost to the Aussie. But of course, the critical thing, and the reason why, by the way, the high yielders such as the Aussie and the Kiwi have been so compressed in such tight ranges, is because the yield curve differential between them and the US dollar has really compressed. As US yields rise almost in a parabolic manner, of course, that makes the Australian bonds and New Zealand bonds far less attractive, and you have all of this carry trade outflows that come out of them towards the US dollar. And conversely, if those yields reverse, if US yields begin to trade back down towards the 225 level, 220 level on a 10-year, it brings all the money right back into the Aussie and the Kiwi. And that's why you're seeing, first of all, such small volatility, simply because there's nothing else really that's going on that's driving the trade as much as the yield curve differential. And secondly, because the market is very much focused on what the FOMC is going to say. If the FOMC next week, or this week, excuse me, essentially telegraphs to us that it's all systems go, there's probably going to be further weakness. We're going to see probably the lower end of the ranges for both the Aussie and the Kiwi. If they, on the other hand, provide a much more dovish posture with essentially communicating the idea of a one and done for, say, 6 months, which is sort of the, I think, the best case scenario for dollar bears. If it's a one and done for 6 months, then the Aussie and the Kiwi have a chance to re-rally towards the range highs. So the ranges, by the way, this week kind of set up sort of in a very interesting fashion. So they're still very, very tight. The 73, 75, 50, that's the range in the Aussie, and it's stayed that range for quite a long time. In the Kiwi, the 70, 72 has been essentially the range for the last 2 or 3 weeks, and we're still going to bounce around those ranges. Again, all of it is really a function of US news rather than Australian news or New Zealand news. Dollar CAD, a very different story here, because of course, you know, it's a story of trading oil much more than anything else. Plus, it's actually gotten a lot of support from better than expected Canadian data. If we get, and lastly, but not least of which, dollar CAD, of course, is also very vulnerable to US yield differentials, but it's a sort of a third component to what moves the currency. Oil is 1, Canadian data is 2, and then yield differentials is 3. Given that structure, you know, we've been very, very bullish dollar CAD for a very long time, and starting like last week, I started to turn more neutral and more cautious on the trade. And I actually think that if you get a reversal in the dollar, if yields, US yields start to come down, oil prices are still very much going to remain at relatively high levels, and that is very likely to turn dollar CAD from a buy the dip to sell the rally trade. As a matter of fact, I would make the point right now that dollar CAD is very much a sell the rally trade, as long as we stay below the 135 level. And so, to me, the trade that I've been bullish for a very, very long time is now starting to become a much more bullish specter for anything that we want to trade going forward. Let's take a look at the charts here and just see how everything sets up on the COM dollar front. So on the Aussie side, this very, very narrow range continues. And as I said, a positive US, a dovish US Fed statement very much gives us a chance to break through these 74, 75 ranges, whatever, 75 ranges, and take us out towards the 75, 50 highs. That still remains a very, very tough overhead because you got a triple bottom over here, but a potential possibility for us to go beyond that and maybe reach towards the higher end of the bigger ranges. A bullish U.S. Statement definitely brings the 73.50 in play, and a break below that really opens up the run towards the 70s in the Aussie on a long-term basis. This basically is a pro-dollar trade that continues into the end of the year. Same kind of a story here with the Kiwi. The Kiwi is a little bit cleaner and more evident. 72 to the upside takes us all the way possibly to 74 as the resist. This is a weak dollar case scenario post FOMC. Strong dollar case scenario really takes us right back down to 70 and perhaps even all the way down to 69 if U.S. yields continue to pair it forward. The one thing, of course, about the Kiwi is that it has a bigger yield differential against the dollar, so it has a bigger cushion. But nevertheless, I think it's going to come under assault if there's a strong pro-dollar move. Now, a weak dollar trade where the Fed is cautious really puts, you can already see that the dollar CAD is already a strong downtrend trade, but it really puts the dollar CAD into the 130 and perhaps even below the 130 trade. I actually think let's go on the longer term charts. You can see that the dollar CAD, after being essentially a buy to dip story, really distributed very, very strongly here in this 34 level. And any kind of a move up into the 32s, 33s still represents to me a very interesting opportunity to short this, because on a relative strength basis, I still think dollar CAD now becomes much more of a sell to rally than a buy to dip trade. But a momentum move to the downside could really run us all the way out to 28.50 before it stops. So on the commodity front, it's the Canadian dollar that looks the strongest to me if the US dollar begins to give way. And both of the Aussie and the Kiwi trade could be finally breaking out of their low volatility ranges as the Fed gives us better clarity as to what comes in the year ahead. Bottom line is the 75.50 is the top side to Aussie we're going to be watching. The 73.50 is going to be very much the bottom side in the Aussie that's going to be very key. 72.70s. 70 and 72 is going to be the ranges for the Kiwi. And with dollar CAD, essentially any kind of a rally, as long as it doesn't take out the 35s to the top side, pretty much provides a strong opportunity for us to sell into the rally for potentially a move back down all the way to 2,800 on the strength of the improving Canadian economy, retracing U.S. yields, and relatively stable oil above the $50 barrel. Wish you guys the best of luck, the best of trading. Boris, over and out.